On June 17th, the Fed did the expected thing. Nothing. The rate held. The S&P slipped barely 1%. The fear gauge stayed calm. The 10-year hardly moved. Every "is anything happening" gauge said no. And yet, underneath, the market quietly rewired itself. Banks rallied, big tech fell. Same afternoon, opposite directions. So, how do you tell what the market is actually saying after a Fed meeting? Start with the puzzle. The Fed left the rate alone, but banks and industrials closed higher, while big tech, real estate, housing, and China fell hardest. The index averaged all of that into a sleepy down 1%. An average can hide an argument, and this one hid a full rotation. Here's the whole day in one chart, every sector on the close. Look for the green. There's exactly one bar of it. Semiconductors up almost 2%. Everything else is red, but not evenly, and that's the tell. Industrials and financials barely dipped. The rate-sensitive groups, real estate, China, consumer, fell 2.5% to nearly 3%. A panic takes everything down together. This left some things standing. That's a resort, not a sell-off. So the first habit is simple. Don't read the index. Read the spread underneath it. A fear day sells almost everything. A rotation picks new winners. The whole question is just this. Was June 17th fear or a decision? Drop to single names and the mechanism is obvious. Banks and defense closed green. RTX, Morgan Stanley. Long-duration names fell 3 to 5%. Microsoft, Amazon, a warehouse REIT, Meta. Why on a day the rate didn't move? Because higher for longer isn't about today's rate, it's about the value of profits that arrive years from now. Picture two paychecks, one this month, one in 2030. Keep rates high, and the far-off one is worth less today, even if the business is unchanged. Banks earn more when money stays expensive. Long-duration growers get marked down. Profits sooner are simply less rate-sensitive than profits later. Now the question that separates a sharp read from a lazy one: did investors buy banks because they got better? Score both sides on the factors that describe a company and watch the shape. The bank profile bulges in exactly one place. Momentum 70 to 58, which is just the recent price move showing up in the math. Everywhere that describes the business, it inverts. The tech being sold scores higher on quality, value, opportunity, and the blended composite. So the market bought momentum, not better businesses. That doesn't make the rotation wrong. It means it leans on the rate story and can reverse when that story does. One afternoon can be noise, so put two clocks on one picture. Today's move across, the past week up the side. Top right is durable leadership, and it's exactly who higher for longer favors. Financials, industrials, and semis, up on the day and the week. Bottom left holds the rate casualties. China, consumer, housing, weak on both. The odd one out sits far to the left, but flat for the week. The Magnificent Seven. Their break is fresh, which makes the next few sessions the test of whether it becomes a trend. Now the most important number of the day, the one that didn't move. With the biggest companies on Earth down 3 to 5%, the fear gauge closed at 16. Calm. Credit stayed tight at 2.66, and the 10-year barely budged at 4.47. Picture two doors. Behind one, rotation. Money walks from one group into another. Behind the other, panic. Everyone runs for the exit at once. The calm gauges tell you which door this was. Leadership changed, fear didn't. Here's the part that stays useful long after today. A Fed decision drops the market into one of four regimes set by two questions. Is policy hawkish or dovish, and is growth strong or weak? Hawkish with strong growth lifts banks and cyclicals and pressures expensive tech and REITs. Dovish with growth intact lifts tech, housing, and small caps. The other two corners belong to inflation scares and growth scares. Lay June 17th on the grid. Banks up, long duration down, VIX calm, the 10-year firm, the cyclical Dow leading the Nasdaq, and it lands in one square, hawkish growth confidence. So what settles it? Not 10 numbers, 3 gauges. And these are a June 17th snapshot, not timeless levels. Yields. The read holds while the 10-year stays near 4.4, it weakens under 4.3. Leadership. It holds while banks lead and big tech stays below trend. Stress. It stays a rotation while the VIX and credit stay quiet. It flips to risk off if the VIX pushes toward 22. That's the point. Not buy banks or sell Microsoft, but knowing what confirms the read and what would break it. Notice this read never came from one chart. It came from stacking them. That's normally 5 different tools. Market Decode puts them on one page. The regime, the sector pulse, the factor scores, the risk gauges, the catalyst calendar. Each screen answering a question the others can't. Leadership, then rotation or panic, then what could change it in one place. From here, the regime gets graded by 2 prints. FedEx, June 23rd, tests the real economy. Micron, June 24th, tests AI demand. If both confirm strength while yields stay firm, the rotation gains credibility. If yields fall and big tech retakes the lead, the market may reverse its vote. After every Fed, the same 5 questions: leadership, momentum or quality, 1 day or 5, rotation or panic, and which regime. If this changed how you read a Fed day, do one quick thing: subscribe to Market Decode and tap like. FedEx and Micron report next week, and we'll come back to this exact regime map and grade whether the market confirmed the signal. This is the regime check. One clear market story every single day.